In our continuing series of presentations on the Tax Cuts and Jobs Act, this presentation will discuss changes affecting businesses. We'll go over a dozen Tax Cuts and Jobs Act changes that will affect businesses and business owners as well. The Tax Cuts and Jobs Act is the biggest tax change since 1986, and we, as tax professionals, all need to be familiar with it. Now, before we begin, you might want to ask yourself, what do I know right now about the Tax Cuts and Jobs Act? Absolutely nothing. I know a little bit. I've researched it and I know a good bit. Or I could do a presentation on this topic. We'll discuss a broad overview, and you'll see that we've divided this discussion into two major types of changes to the tax code. Changes that affect corporations and businesses the most, and changes that will affect individuals. The changes can be hard to categorize, but we've tried to lay out the presentation in a logical format. So, here are what we think are among the top 12 Tax Cuts and Jobs Act changes affecting businesses and their owners. These are the largest changes and will have the biggest impact on businesses and business owners. As we go over each change, we'll zoom in just a little and attempt to give a frame of reference for each. First, the corporate tax rate was lowered and the AMT was eliminated. The net operating loss deduction is limited and the carryback has been generally repealed. There's an expanded 100% depreciation deduction. The bonus depreciation was going to be down to 50%, was expanded to 100%, and we'll go into more detail on this in just a few moments on why this is significant and how it fits into the logic of the policy and decision making within the Tax Cuts and Jobs Act. Section 179 expensing has been increased, and the domestic production activities deduction has been eliminated. The business interest deduction has been limited, but may carry forward. Number 7, like-kind exchanges are now limited to real property. The effects on like-kind exchanges could be significant according to your client's particular situation, and again, we'll go into this in more detail later. Number 8, the individual income tax rates did not go down as much as the corporate tax rates. There's a new 20% qualified business income deduction for non-corporate taxpayers. This can be very complicated, but at the same time, it's a very important provision in the new tax code that we all need to be familiar with. There'll be a transition from a worldwide tax system to a territorial international tax system. There'll be a change to deduction limitation for excessive employee remuneration. And there were changes to the deductibility of fringe benefit expenses, which we'll discuss as we get to that topic. Just a few disclaimers. The Tax Cuts and Jobs Act went into effect on January the 1st, 2018. There hasn't been much guidance that's been issued, but guidance on some of the finer points of the Act is finally starting to trickle out. So references made to pre-reform law are to the tax laws that were in effect on December 31st, 2017. Specific IRS regs and guidance haven't been issued on any of these points as of June 30th, 2018. The exception being the 3-year carried interest holding period. The information in this presentation is meant for educational purposes only and shouldn't be relied upon as tax advice. Let's talk about expiration dates and sunsets. In order to comply with Senate rulemaking constraints, many of the provisions in the Tax Cuts and Jobs Act will expire or sunset in 2026. Revisions and extensions are heavily anticipated. We're all familiar with having to deal with so-called extenders each year, so there will be extenders on steroids when many of these provisions expire in 2026. So depending on who's in control of Congress and the White House, we could be in for another round of extensive changes to the tax code when these rules finally sunset. We anticipate changes as a result of the unintended consequences of this new tax legislation. So let's jump into our top 12 changes from the Tax Cuts and Jobs Act that will be effective for businesses and business owners. The corporate income tax rate and AMT first. On this slide, we'll look at the pre-reform law and what's effective for 2018. The top corporate tax rate dropped from 35 to 21%, and the corporate AMT was repealed. These two provisions were actually part of the driving force behind the act itself. Tax reform in 1986 focused more on individuals, and the Tax Cuts and Jobs Act is focused more on corporate issues. The high corporate tax rate in the United States gave incentive to many businesses to relocate overseas in order to avoid the corporate tax. Part of the solution in bringing corporations back to the States was to lower the corporate tax rate. Repealing the corporate AMT, alternative minimum tax, was very important in that it simplified the tax structure and the tax reporting for many corporations. Number 2 on the list, net operating loss deductions. So, if you repeal AMT, then you must do something to reassure Congress that everyone is paying their fair share. So, one of the things that the Tax Cuts and Jobs Act did was to eliminate the net operating loss carryback. This helped in smoothing things out from a revenue perspective. The deduction, limited to 80% of taxable income language, ensures that almost everyone pays something. Number 3, the 100% depreciation deduction. The pre-reform law phased out after the PATH Act of 2015, so in 2017 would have been 50%. Effective September 27, 2017, qualified property placed in service after September 27, 2017 can be 100% depreciated in the first year of service. It's expanded to include used property. And this went into effect early, before January the 1st, 2018. There's two very big changes that can move businesses away from debt financing and more toward equity financing. This is one of them. Another reason for this particular provision is to encourage investment. A business will see a rate of return immediately, as opposed to over a period of time. Number 4, Section 179 expensing. Pre-reform law had a $500,000 limit. There's a $2 million phase-out threshold. Effective 2018, we have a $1 million limit and a $2,500,000 phase-out threshold. The limitation was raised from $500,000 to $1 million. The phase-out threshold was raised slightly from $2 to $2.5 million. Why would you want to calculate depreciation as opposed to Section 179 expensing? Well, there's fine details between the two, so it pays to run the numbers both ways to see which will benefit your client the most. Domestic production activities deduction, number 5. This one is probably the easiest slide. The domestic production activities deduction is gone. On the pre-reform side, this is one of the stipulations of the Tax Cuts and Jobs Act that will help offset the reduction in tax rates and actually help to raise some future tax revenue for the federal government. The business interest deduction is important. Normally, this applies to domestic interest. There's now a limitation on the deductibility of interest. This is another way that businesses will move from debt financing to equity financing, but there are exceptions. There are options for real property businesses and farming businesses to irrevocably opt out. Floor planning interest isn't considered interest for limitation purposes. There'll be an indefinite carryover for unused expense. Like-kind exchanges. Now this is a big deal. Pre-reform law, like-kind property could be real property or personal property. Effective 2018, exchanges other than for real property have been eliminated. A lot of companies used like-kind exchanges for all kinds of property. The law stayed the same for real property, but it did change for personal property. So at the end of 2017, there are a lot of exchanges of personal property such as art and classic cars and other high-value personal property. This will be big for the future. It'll probably have an unanticipated impact. Businesses and their advisors may try to get this changed. This may hit or will hit virtual currency. We can see lobbyists trying to have an exception to this rule passed in the case of virtual currency, bitcoins, and so forth. This like-kind exchange provision will more than likely cause problems in the world of virtual currency, cryptocurrency, and again, bitcoins. There is some protection for forward or reverse exchanges in progress as of December 31st, 2017. Now in this slide, we see that the individual tax rates are being lowered from a top rate of 39.6 to 37%, so not anywhere near as steep as the corporate tax rate reductions, and for median wage earners, a reduction from 25% to 22%. Not going to spend a whole lot of time looking at these tax rates and tables. So we'll move on to number 9, state and local tax deductions. Another big deal. The pre-reform law, your state and local tax deductions were unlimited, included property and income or sales taxes. However, effective 2018, limited to $10,000. Your state and local tax deductions are limited to $10,000. This is another big deal. The reaction of the states to this provision is interesting, in that states like New York and California are talking about passing legislation that will categorize their income taxes as charitable contributions to the government. Now we can draw our own conclusions from this, but it's an interesting concept nonetheless. This $10,000 includes property and income or sales taxes, and it's still deductible for C Corps. State and local sales or property taxes accrued in carrying on a trade or business or in the production of income. Next, the new 20% qualified business income deduction. This is the new deduction for pass-through entities. Now, pass-through entities drive business in our nation's economy. These provisions help equalize the tax cuts that the C corporations received and that the individuals didn't. And this 20% qualified business income deduction helps to equalize that, but it's targeted. And this 20% QBI income deduction will affect individuals, trusts, estates, partnerships, S-corps, sole proprietorships, and LLCs not taxed as corporations. It only applies to qualified business income, and is subject to a phase-out for specialized service trade or business. Now, this qualified business income deduction is the most complex and hard to understand part of the Tax Cuts and Jobs Act. We've included some flowcharts here in this presentation to try to help. The first is a quick summary of some of the limitations for QBI deductions. Are you a non-corporate taxpayer? Do you have income from a qualified trade or business, which we hope later on will be more clearly defined by the IRS? If so, is that income treated as qualified business income? Again, another term, qualified business income, we're going to need some guidance on. Do any of the wage or capital limitations apply? And does the overall taxable income limitation apply? Now, Congress wanted this QBI deduction to go to employers and not to independent contractors, so businesses that pay wages will get the most benefit from the deduction. So what exactly is QBI, the Qualified Business Income and the Qualified Business Income Deduction? Well, Qualified Business Income, or QBI, is the net amount of qualified items of income, gain, deductions, and losses with respect to any qualified trade or business of the taxpayer. And this is a quote taken directly from the code, from the Tax Act. So what does this mean, or better yet, let's try to define what it's not. Now, QBI is obviously income from a business, but what's that? Well, QBI does not include wages earned as an employee. It doesn't include investment income, and investment income include short-term or long-term capital gain or loss, dividend income, and interest income. A specialized trade or business is carved out in the provisions of the Act. Now, this is a high-level description of which industries are included. Specialized service trade or business, or SSTB, for purposes of the Section 199A deduction, that's the qualified business income deduction, the 199A, is any trade or business involving the performance of services where the principal asset of such trade or business is the reputation or the skill of one or more of its employees. That's IRC Section 1202E3. Now that could apply to independent contractors. Fields specifically included in SSTB are health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investing and investment management, trading or dealing in securities. Now you can see that a lot of services are included, but it's difficult to say without any specifics. Again, we'll need some future guidance on detailed situations going forward. Now, one point to make is that rental income is not excluded from QBI. If I own a substantial equipment rental company, or if I rent apartments or hotels, it would be a huge savings for my company to be able to take advantage of this QBI deduction. Also included here, partnership interests or commodities. Now, one important point to take note of in this 20% qualified business income deduction provision is that architecture and engineering are specifically excluded from the definition of specialized service, trade, or businesses. Now let's look at the QBI deduction for specified services, and everything, all the numbers here are for married filing, joint filing status. The amount of taxable income, if you have $315,000 or less, it's not subject to the specified services limitations. But don't stop here. If it's greater than $315,000, if the amount of taxable income is greater than $315,000 but no more than $415,000, then any potential QBI deduction is going to be subject to phased-in wages and capital limitations. More than $415,000, not eligible for the QBI deduction. So in other words, your QBI deduction could be limited. The income levels are all from married filing joint returns. So this works for accounting firms and law firms. Over $415,000 in taxable income means no QBI deduction. And keep in mind, guaranteed payments to partners is not considered qualified business income. If you have equity partners who can get their income below $315,000, then they wouldn't be subject to this specified services limitation. Now this flow chart, this next slide, will help determine whether or not the QBI deduction applies. If the amount of taxable income is less than $315,000 or $157,500 for married filing separate, then the QBI deduction is 20% of qualified business income. In addition, there's an individual limitation. The QBI deduction can't exceed 20% times the taxable income minus any capital gains. Next, let's take a look at the next bracket. The amount of taxable income between $315,000 and $415,000 married filing joint, and $157,500 and $207,500 married filing separate. Let's consider a specified service, trade, or business. If you do not, or if the taxpayer does not have or own a specified service, trade, or business, then the QBI deduction is subject to a phased-in W-2 wages and qualified property limitation. And if the taxpayer does own a specified service, trade, or business, then the QBI deduction is subject to a phase-out limitation based on an applicable percentage. Now, this next flow chart gets a little busy. The next category, more than $415,000 married filing joint or $207,500 married filing separate. But I'm going to kind of buzz through this real quick, put all of the parameters up here on the slide, but just suffice it to say that if you don't have qualified property or W-2 wages, you won't receive a deduction. If you're an independent contractor and you're not paying wages, you're not going to get the QBI deduction. If you do have them, then you get the greater of 50% of W-2 wages or 25% of wages plus 2.5% of the company's assets. If it's more than $415,000, if the amount of taxable income is more than $415,000, and you're a specified trade or business, then you won't receive the QBI deduction. And again, there's an individual limitation. The QBI deduction can't exceed 20% times the taxable income minus capital gains. So as you can see from all of this, from these past three slides, from these past three flowcharts, we've got some calculations ahead of us. Again, this QBI deduction is the most complex and probably will have the most questions asked of it in the Tax Cuts and Jobs Act and in our upcoming tax season. There's still some unanswered questions. What's the scope of the term qualified trade or business? What activities are included? What activities are excluded? Allocation of qualified property to partners, particularly with respect to IRC Section 704 allocations and debt-financed property. Allocable share determination for partnerships using complex economic sharing arrangements. There'll be a lot of questions on that. Finally, let's move on to number 11. Worldwide to territorial international tax system. Pre-reform law, taxpayers are subject to tax on their worldwide income. Effective 2018, generally, corporate taxpayers are subject to tax only on income earned within the United States. This moves the U.S. more toward a territorial tax system. Dividends from foreign subsidiaries are exempt from tax. And then one thing that goes along with this is the repatriation of foreign earnings and a one-time tax on 10% shareholder of a foreign subsidiary of a U.S. corporation. Each shareholder must include pro rata share of accumulated post-1986 earnings and profits using the higher of November the 2nd, 2017 or December 31st, 2017. Tax will be 15.5% of the shareholder's share of cash and cash equivalents, payable in installments. And our last topic of discussion for how the Tax Cuts and Jobs Act will affect businesses and business owners, employee benefits and executive compensation. Effective 2018, there'll be a limitation on the deductibility of executive compensation and an excise tax on certain nonprofit executive compensation. Changes to the tax treatment of certain fringe benefits, and elimination of the individual mandate, the Affordable Care Mandate, and that won't come about again until 2019. First, limitation on the deductibility of compensation. Code Section 162M limits the amount of compensation paid by a publicly traded business to certain senior executive officers to $1 million per year. Effective in 2018, the TCJA eliminates the exceptions for commissions and performance-based pay. There's an excise tax on certain excess compensation of tax-exempt entity employees, and this one will affect nonprofits. Effective in 2018, any tax-exempt employer must pay an excise tax of 21% of amounts paid to the 5 highest paid employees of such employer over the first $1 million. There are some exceptions to this, and thoughts are that to the extent that you're compensating an individual more than $1 million, then it's more like a business than a charity. Couple of interesting points going forward. You can't deduct expenses for gym facilities and qualified transportation anymore. Effective 2018, amounts paid for on-site gyms and qualified transportation expenses for tax-exempt entities will be treated as unrelated business taxable income. Fringe benefits, entertainment, amusement, and recreation expenses. Employers can't deduct entertainment, amusement, and recreation expenses, so in essence they just took all the deductions for having fun out of the tax code. Employers may continue to deduct business entertainment expenses provided that they're included in the employee's income. Fringe benefits, unreimbursed trade or business expenses. From 2018 through 2025, employees may not take a deduction for unreimbursed trade or business expenses. Independent contractors, however, remain eligible for this deduction. Commuting benefits. Effective 2018, employers may not deduct amounts paid for qualified mass transit or parking benefits for employees, except where such benefits are necessary for the safety of the employee. Effective 2018 through 2025, employees may not exclude from gross income or wages qualified bicycle commuting reimbursements. Moving expenses. Very important. For 2018 through 2025, employees may not exclude from gross income moving expenses paid by an employer. There's an exception for active duty military personnel, however. And just some noteworthy items that'll come down the pipe from the TCJA: qualified opportunity zones, sexual harassment settlements, and the ACA, the Affordable Care Act, the individual mandate repeal. First, let's talk a minute about qualified opportunity zones. Effective December 22, 2017, governors may designate low-income areas as qualified opportunity zones. This allows deferral of capital gains through reinvestments in corporations and partnerships. Gains on sale of these investments are exempt from tax after a 10-year holding period. Sexual harassment settlements. The news is finding its way into the tax code. So basically, if there's a non-disclosure, it's non-deductible. This one's definitely an issue of our time. Effective December 22, 2017, the deduction for settlement, payout, or attorney fees related to sexual harassment or abuse is disallowed if the payments are subject to a non-disclosure agreement. The Affordable Care Act, the individual mandate will be repealed. The TCJA repeals the individual mandate, again effective 2019. This change doesn't affect the employer shared responsibility requirements. Again, it does not affect the employer shared responsibility requirements or the employer's reporting requirements. And that pretty much sums up our presentation on the Tax Cuts and Jobs Act and the changes that will affect businesses and business owners. Thanks for watching.